Welcome to Kitco News. I'm Niels Christensen. Joining us today is Juan Carlos Artigas, Head of Research at the World Gold Council, here to talk to us today about first quarter gold demand. Thank you very much for joining us, Juan Carlos.
Thank you so much for having me. It's great seeing you today.
It's great seeing you today too, because there's just so much to talk about. So much happened in the first quarter in the gold market, some good, some bad. I wanted to really drill down on ETF demand. We saw 300% increase in demand for gold-backed ETFs in the first quarter compared to the first quarter of 2019. Is this pace sustainable? Should we be worried about this pace of inflows?
Look, I think that when you do a comparison like that with in quarters or comparing year to year on ETFs, it may be giving a misleading perspective because unlike the jewelry market, ETFs are not, or ETF demand is not seasonal. So let's just look at what is happening and in particular at the ETF market. And yes, we've seen very strong flows, reaching record highs in many regions. But what is really important to understand is that the growth in ETFs over the past couple of years has come from many places, not just the US. So in fact, when you look at US and North American holdings only, we are still away from where we saw ETFs reaching in 2010 and 11, a few years ago, just on the aftermath of the financial crisis. So the reality is that ETFs are just giving you a perspective that investors are indeed looking for hedges to hedge their portfolio, and gold-backed ETFs are one of the vehicles in which they can, they have been doing so. It has been strong, but I think that it's not necessarily unprecedented.
What's your thoughts on the health of the gold market? I mean, we did see this big drop in jewelry demand, which we know is sort of the biggest sector in the gold market. Is the sector healthy?
And we started talking about ETF flows, and I think that it's important to take a bigger picture and as you mentioned, look at the whole market. Gold has a dual nature, right? But even within investment, ETF flows or ETFs are not the only way in which investors are buying gold or access gold generally. You also saw quite healthy demand in terms of small bars and coins through unofficial coins in particular in Western markets, which is a similar sentiment to what is happening. But the other side of gold, the consumer demand, saw some softening in Q1, and that was to be expected. Even before the pandemic really started to expand as much as it did in Q1, at the end of Q1. In our outlook, we were talking about a possible deceleration on consumer demand. So it has come down. It is a combination of higher prices, but also expectations of lower growth, and that again is something that you can expect in this type of environment. Of course, the lockdowns really start to kick in other places, in places other than China, much later in the quarter. So we will get to see more in Q2, the effects, and you will expect, or we expect, some deceleration in the consumer market. However, again, if you look back historically, and yes, these are unprecedented times, but you can understand the dynamics, the dual dynamics of gold. Generally speaking, deceleration in consumer demand in these types of environments tend to be offset by strong investment flows, as investors tend to look for high quality liquid assets or for safe havens like gold to preserve and protect their wealth.
One of the things that you and I have talked about quite often is one of the best environments for gold is an expanding economy. You get growing middle classes is good for the gold market. Recently, we heard the IMF say, we could be facing the biggest downturn since the 1930s Great Depression. So are you expecting to see lower gold demand in this environment? I mean, and how does that offset with the investor demand and the need for an inflation hedge?
Yeah, and not only an inflation hedge, but really kind of like a hedge to the full sort of a full list of risks that investors are facing at the moment. But to answer your question, the impact of economic growth in performance of gold is really on the long term. But what we need to understand at the moment is that, again, there's an interplay, and it will really depend on not only perhaps the impact that it will have in the short term, but the impact that it may have on the long term. In other words, how long the recovery may take. If this is a really concentrated impact on the economy that lasts, for a quarter or two, and then there's some rebounding, there will be other aspects of the economy, including the jewelry sector and others, that may be able to recover as well. So it's a little bit of a wait and see approach to understand the length and the impact, again, not only in a specific quarter or in a specific year, but the longer term effect, as to how that will translate to gold's long-term performance. However, historically speaking, weakness in consumer demand has been offset by investment demand and investment flows.
So now there's also a third pillar in the gold market, central bank demand. I mean, last year, 2018 and last year, unprecedented demand from central banks. That's kind of dried up now. 6 central banks bought gold, over 10 tons in the first quarter. What's your expectation from this sector? Do central banks have money right now to increase their gold reserves?
Our expectation at present, and even data as of March release from the IMF, seems to suggest that central banks continue to be buyers, net buyers of gold. We expect for 2020 for central banks to continue to being net buyers. Gold can be a very useful asset and an addition to their foreign reserves. At the same time, we do expect, the net demand coming from central banks not to reach the same levels that it did in the past couple of years, where it was, kind of like really reaching record levels. So there might be some deceleration in purchases, and some central banks may be using gold, in active ways in their foreign reserves. But all in all, for this year, we expect net purchases to continue.
So I guess you're not worried about central banks selling. We've heard stories from Venezuela about having to sell their gold to cover healthcare costs because of the pandemic. You're not concerned at all that we could actually start seeing, for the first time in 10 years, net selling?
Well, there have been isolated sellers throughout the past 10 years, but it's more the collective perspective on emerging market central banks and central banks more kind of like generally, where you can see the health of the gold market. So in terms of a net collective perspective, for this year, we do expect this to remain positive, even if there's, of course, throughout the year, potentially some of the banks, are more actively using or participating in the gold market.
I always ask you this question. It's a question I really like to ask. As the research, as you compiled the Q1 report, what was the most surprising fact or figure that jumped out at you at this report? I mean, for me, it was the unprecedented ETF demand. I mean, we saw gold holdings reach record levels. We saw asset values of those gold holdings reach record levels. Just massive investor demand. But for you, what was the surprising factor for Q1?
Yeah, and I think that the global nature of the market is truly relevant, and I think always stands out. It never ceases to perhaps draw my attention on the fact that even when you look at ETF flows, again, when you dial back the clock and you look back 10, 15 years ago, that vehicle was very much a kind of like North American phenomenon. Well, this time around, I mean, it's truly a global phenomenon, and you saw quite healthy inflows from all regions. So it's all investors, using gold as a way to protect and hedge their portfolios. Also the health and the relevance of the investment market, in particular in Western markets, draw my attention. There were quite strong, official coin sales happening in particular in the West, and perhaps it was more the understanding and the actual level of deceleration in consumer demand that we were paying attention to, because we knew that may be happening in Q1, but of course we didn't have figures. Now, all that said, we will continue to monitor the market, because of course there's a lot of information coming in and will continue to come in, and we may need to revisit some of those figures as time goes by, again, as more information becomes available. But I think that it was a really interesting report from the perspective of seeing overall demand inching up slightly, driven by investment flows, but also the deceleration in the consumer market, truly highlighting the dual nature of gold.
Excellent. Thank you very much, Juan Carlos, for taking us through your research. I think it's just definitely going to be a fascinating year for the gold markets to see what trends emerge in 2020. I mean, we're getting a taste, and I guess we'll see if things continue. But thank you very much for joining us today.
On the contrary, thank you so much for inviting me. It was great seeing you.
Thank you very much for watching Kitco News. For all your information in the precious metals markets, go to kitco.com. Thank you very much. Stay safe and stay healthy.